There is a dividend sitting in your brokerage account right now that is smaller than it was last year and the year before that, and almost nobody making SCHD content is talking about it. I know that sounds wrong, because if you've spent any time watching dividend investing videos, you've probably heard the same number repeated over and over. SCHD has an 11.61% 5-year dividend growth rate. It's practically the fund's slogan at this point, and that number is real. I'm not here to tell you SCHD is secretly terrible. But that headline is hiding something, and if you don't know what it is, you could be making a planning mistake that doesn't show up until it's already cost you. So here's what this video is actually about. The June dividend payment from SCHD has shrunk 2 years in a row, not the annual total. The specific quarterly payment you received in June, down 5.28% in 2025, then down another 2.96% in 2026. And the reason that's happening comes down to two structural things baked into how the fund is actually built. Things that most SCHD content gets completely wrong or just skips over entirely. We're going to go through both of them, and I'm going to show you the exact math so you can go check your own brokerage statement and decide for yourself whether your SCHD allocation still makes sense for your situation. I pulled the split-adjusted dividend history directly, ran the numbers in Python, and cross-referenced the S&P Dow Jones methodology documents and the March 2026 reconstitution coverage. So this isn't vibes, it's checkable. Let's start with the thing that I think is the most genuinely misunderstood part of how this fund works, because it's the one that explains almost everything else. Most people think SCHD is weighted by dividend yield. Like the stocks with the highest yields get the biggest positions. That sounds logical, and honestly, it's how most people explain it. Even people who make finance content for a living. But it's wrong. Dividend yield is only used to decide which 100 stocks get into the fund in the first place, alongside things like cash flow to debt, return on equity, and 5-year dividend growth history. Once a stock makes that cut, the fund weights it by modified market capitalization, capped at 25% per sector and 4.5% per individual stock. So the biggest position in SCHD isn't the highest yielder, it's the biggest company that survived the screen. That distinction matters a lot more than it sounds, and here's why. Right now, SCHD's top 10 holdings make up about 41 to 42% of the entire fund. Run the math on the cap structure. 10 stocks times the 4.5% individual ceiling equals 45% as the theoretical maximum concentration those 10 positions could ever reach. SCHD is currently sitting at roughly 92% of that ceiling. The fund is not in some comfortable middle zone, it is running right up against the edge of the most concentrated portfolio its own rulebook will allow. And this isn't a manager making a bold call. This is the index mechanically drifting toward its own guardrail as the largest qualifying companies get bigger. When you hear diversified across 100 stocks, that's technically accurate. But the actual risk behavior of this fund is closer to 25 or 30 effective bets, not 100. That's important on its own, but if you don't also understand what happens every March, the concentration piece only tells half the story. Every year, SCHD goes through a reconstitution. The index formally reviews all 100 holdings, kicks out the ones that no longer qualify, and brings in new ones. In March 2026, that meant 22 holdings were swapped out and 25 new ones came in. That's roughly 22 to 25% turnover in a single reconstitution event, which is close to the 28% average annual turnover that S&P's own research documents for this index. And the thing that makes this genuinely counterintuitive is how the selling decisions get made. The index doesn't sell the losers, it sells the winners whose yields have compressed. Energy is the clearest example from this year's reconstitution. The sector had run up to somewhere between 20 and 24% of the fund, approaching the 25% sector cap. So in March, the reconstitution cut energy exposure by about 8 percentage points. Names like Valero Energy, which was up roughly 80% over the prior year, and Halliburton, up about 46%, gone. Not because anything was wrong with those companies, but because they'd gone up so much that their dividend yields had compressed and the index's rules said it was time to sell. That's the actual mechanical engine running underneath SCHD. Sell strength when it no longer yields enough. Buy relative weakness, that does. It's the opposite of how most people instinctively manage a portfolio. And it's the same engine that drove the fund's 478% cumulative return since 2011. The system works, but it creates real choppiness in the dividend stream that the 5-year CAGR number completely smooths over. Here's what that choppiness looks like in practice. The June 2024 payment was $0.2747 per share. June 2025 came in at $0.2602. That's a 5.28% drop. June 2026 came in at $0.2525, another 2.96% drop. Two consecutive June payments, both smaller than the year before. Now, to be fair, the March and December payments grew. March 2026 was up 3.26% year over year. December 2025 was up 5.18%. So the first half of 2026 totaled $0.5094 versus $0.5090 in the first half of 2025. Essentially flat, up about 0.08%. The annual growth story technically survives, but if you're someone who relies on that June payment for something specific, if you've built a budget around it, or you're tracking your progress toward a monthly income target, that quarter genuinely paid you less than it did 2 years ago. That's real, and it's verifiable on your own statement. Let me put some actual position size numbers on this so it's not abstract. At SCHD's current trailing yield of about 3.30%, the share price is around $31.72 right now. A $50,000 position generates roughly $1,652 a year, or about $413 per quarter. A $150,000 position gets you about $4,956 a year, $1,239 per quarter. And a $290,000 position, which is a number that comes up a lot in comments from people who've been saving for a while and are trying to figure out what to do with it, that generates around $9,581 a year, or about $2,395 per quarter. Those are real numbers. And when one of those quarterly payments shrinks by 5%, that's a real difference in your actual cash flow, not just a rounding error on a spreadsheet. Now, there's one more layer here that almost never gets mentioned, and it connects directly back to the reconstitution turnover we just talked about. SCHD gets a lot of credit for being tax efficient, and that reputation is mostly earned. The dividends are 100% qualified, meaning they're taxed at long-term capital gains rates instead of ordinary income. For 2026, the 0% bracket goes up to $49,450 for single filers and $98,900 for married filing jointly. So a lot of people watching this are paying nothing on those dividends in a taxable account. That's genuinely good. But here's the part that almost nobody mentions. Every time the March reconstitution sells a position inside the fund, like it did with Valero and Halliburton this year, that can generate a realized capital gain that gets distributed to every shareholder at year end. Even if you personally never sold a single share, the tax-efficient praise is specifically about the qualified dividend treatment. It is not a guarantee that you won't receive a capital gains distribution from reconstitution turnover in a taxable account. If your SCHD is sitting in an IRA or a 401k, this doesn't affect you at all. The gains just stay inside the account, but if you're holding it in a regular brokerage account, this is worth knowing before December. So let's bring this together because I want to make sure the picture is clear. SCHD is not broken. The fund has done what it was designed to do for 15 years, and the mechanical rules that cause all of this, the market cap weighting, the sector caps, the annual reconstitution, those are features, not bugs. The 478% cumulative return since 2011 came from exactly this system working as intended. But the mistake people are about to make in 2026 is treating the 11.61% 5-year growth rate like it's a smooth, predictable escalator, when the actual dividend stream is lumpy by design. Some quarters grow, some quarters shrink. The annual number looks clean because the math averages out across 4 payments, but your brokerage statement doesn't show you averages. It shows you what actually hit your account. And if you built a retirement income plan around SCHD, assuming every payment grows every quarter, the June number is going to confuse you at best and cause a bad decision at worst. The 2 things worth checking right now. First, go look at your actual June payments from 2024, 2025, and 2026, and compare them. If you see what I showed you, smaller, you now know exactly why. Second, if SCHD is in a taxable account, make a note to check for capital gains distributions in December, especially in a year with heavy reconstitution turnover like this one. If you found this useful, there's a video on this channel that goes deeper into how to actually structure a dividend portfolio across account types, taxable, Roth, traditional, to minimize exactly the kind of tax drag we just talked about. That one's worth watching next. And if you want to keep seeing content like this, actual data, actual math, no fluff, subscribing helps the channel keep doing it. One question I genuinely like to hear from you in the comments. When you looked at your June SCHD payment this year, did it match what you were expecting? Drop the number if you want. I read these and it actually helps me understand what the next video should cover.